Okay, in the previous video, we had started looking at a predetermined overhead rate, which we have to calculate usually in the fall, that we're going to use the whole next year. And we're going to have to estimate the total overhead cost. We're going to divide that by the total overhead cost driver, and that will give us the predetermined rate. Well, we'll use that rate the whole next year. So here's an example. Assume that CCF Company estimates the total cost for next year of overhead related items is $100,000, and that their cost driver, they're very labor intensive, and so they use direct labor hours as their cost driver, and they estimate they're going to have about 8,000 of those. So we need our estimated overhead costs divided by our estimated cost driver or allocation base. And so in this case, our costs, estimated costs are 100,000. Our estimated cost driver is 8,000. So 100,000 divided by 8,000 is $12.50 per labor hour. And that'll be the rate that we use for all of next year. Then each job that we get during that next year, we'll figure out how many direct labor hours was in that job each month, multiply it by the $12.50, and that's how much overhead we're going to apply to that job for that month. So this goes reminds you that the job cost sheet acts as a subsidiary ledger to work in process. It shows all the direct materials, all the direct labor that specifically went on to that job, and then plus the amount each month that we are going to apply of overhead. When the job is completed, if it's not complete at the end of the month, well, I just carry it over to next month and I keep adding more materials, more labor, and more overhead. But once it is completed, I'm going to add all those, I'm going to total all those costs up, and I'm going to transfer that job from work in process to the finished goods account. So here is Charles Custom Furniture, CCF, and this was a TV cabinet. Here was all their direct materials. We totaled them up. Here's the direct labor. We totaled that up. Here's the overhead that we applied this month. And we have that total. We summarize all those totals and get the grand total. Cost us $2,616.61 to make this TV cabinet. Now, that's the number we'll use we'll take that amount out of work in process and put it into the finished goods inventory. Now, that was just one TV cabinet that cost us $2616.61. What if the job was cheap TV cabinets and we had built 10 of them for one job, okay, that we were going to sell to Walmart or whatever? So in that case, we would have taken the total cost, divided it by how many were in that job, 10, and that means that each cabinet cost us $261.66. Okay, the grand total cost, we're going to debit finished goods inventory. We're going to credit work in process for that cost, $2616.61. We have a special name for that cost of goods manufactured, COGM, or cost of goods manufactured. Okay, and we would also, besides debiting finished goods, I would also put it into the subsidiary ledger that's attached to finished goods. If this cabinet then sold for $4,500 to the customer, we would have to debit cost of goods sold and credit finished goods inventory for the cost of $2616.61. We would credit sales for the $4,500 and debit cash if we received cash from the customer or if the customer bought it on account, we would debit accounts receivable. To compute the gross profit on the cabinet, we would take the sales price of the cabinet minus what it cost us, and that's the gross profit that we made on this cabinet of $1883.39.